If you look at the falling price of oil and other commodities, what does that mean for the global economy?
Well, it's clearly positive. The question is, what is this fall in prices signaling? I want to emphasize in oil, the fundamental physical picture is still intact. Inventories are drawing. You saw it in last week's data, the satellite data, they're drawing, you're in a deficit, forward curve is backwardated. The financial market, however, is where the bearishness is, and it's trading the forward outlook, not today. So we look at this decline in prices, it's telling you nothing about the current situation, but rather what it's telling you about is the future situation. And they expect weakness in China to dominate. I'm not trying to say China's okay today. It's weak, but it's not impacting the oil market that significantly right now. The second thing is OPEC, spare capacity. And the third is U.S. shale. Those are the three factors that are driving the weakness today. I give credence to the Chinese concern, but the other two, I think they're overblown.
So, Jeff, this is basically a sign of mounting weakness in the global economy. It's not some sort of stimulus that could lift up the economy.
Well, I think, it's not that large of a pullback. Let's say, low 80s to low 70s. It helps at the margin, but it's not significant. I think ultimately what it's reflecting across the board is concerns around China. And I want to emphasize, yes, China is weak right now, but the market response is overblown. So let's talk a little bit about China and what's going on there. Let's start with the energy market. The year-over-year declines have a lot to do with base effects. If you recall, last year, China came roaring out of COVID. You had a lot of restocking going on. That pushed the demand level up substantially during third quarter last year. This time around, you have destocking going on, and the level is going down. So the gap, the year-over-year declines are quite large, 500,000 barrels per day, and that's what has the market worried. When we think about that decline, 1/3 of it is associated with energy transition, like trucks shifting out of diesel into LNG. This 2/3 of it is associated with economic weakness. And that's the one I think people are concerned about and focused on. We think it's temporary as you go into fourth quarter, and we expect it to see a lot of it is base effects. It just gets easier on the comp. But the monthly data is showing a turn. I also want to point out another thing that's driving that weakness is the rate differential between the U.S. and China. China's been cutting. U.S. has stayed at the very high levels. That pulls capital out. The last quarter's capital outflow was a minus 14.8 billion. That's a very large number for China. And I always said the best way to get around capital controls is use commodities to move them out.